Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks, everybody, for listening and watching.
Great to be here as well. So, for those who have listened to our podcast for a while and have watched us on YouTube, you know we're not known for our brevity. We tend to go deep into topics. We have really good back and forth. We kind of discuss from lots of angles, and we usually go about an hour. So, recently, Trish and I have been kind of wondering, like, should we try to be a little shorter? This is in line with things like people on TikTok giving financial advice. So I don't have to like keep using those air quotes, but they keep giving different ideas on how you can get rich by paying for their coaching courses. And we've been like, we don't necessarily, I don't know if we're capable of going from 1 hour down to 5 minutes. So that's one thing. And we've been trying to think, can we go shorter? Should we try and go shorter and try and do more frequently? But on the flip side, when we look at like some of the TikTok videos on finances, they're so bad, we don't want to be associated with them. Like we don't want to like stoop down to their level. And we wanted to try and look at a few different ways that if nothing else, just like the red flags we see when we see some of these videos and why it's such a bad idea. And so we might end up taking like a 5-minute topic and expanding it to an hour. Like, here's all the reasons why this could be wrong for you, wrong for lots of people, bad ideas, not necessarily illegal, I don't think most of the time, but could be sometimes. But that's kind of like our topic for today is TikTok financial videos relative to like, should we be shorter, or is it even possible to do something like a good topic that quickly without going to our normal length of nuance and depth? So, Trishul, is there something like you wanted to get us started with? We don't necessarily want to go talk about a specific video. I've seen enough of these that there are some trends, I'll say. Or do you want to start with just the fact that like we tend to be long and we try to go in depth to try and make sure that it's applicable to as many people as possible, but also here are the situations where it's not applicable? And like, do you think we could is it possible for us to get shorter?
I'm going to be a bit skeptical here on that last premise. I'm looking at how long this intro has taken. It's 3 minutes.
Okay, that's good. Good point. We're
3 minutes and 20 seconds. And we haven't really got I don't think a TikTok is even, I don't have TikTok, but I'm assuming they're like 20 seconds, 30 seconds.
I would say there's something like a 20-30 second intro and then like a 4 to 5 minute video of them on a chalkboard or a whiteboard like explaining something.
Okay. Yeah, that might require scripting and punchlines and snappy conclusions.
It's always some kind of clickbait, like you should not invest in your 401k. Okay. You should do this instead.
Right.
Here's how to use real estate to stop working. Here's how to buy a business to generate $250,000 in passive income.
Yeah.
Like, those are some of the kind of themes that I've seen, I've been exposed to. Like, and I like those are like some of the red flags that I'll get to later. But yeah, let's say they're a 20-second clickbait and then a 5-minute video.
Yeah. I mean, I think it's anathema to the title of our podcast, which is it's a spectrum, right? There's
Okay.
nuances to all of this. It's in those nuances where you discover where things are more subjective, when things are more rational, where things can be more analytical. But it takes that discussion to uncover the grays in all of this.
So, okay, maybe like we could even like look at a few of the topics that we've seen and break down how they could be applicable and why most of the time they're not.
Sure, yeah, we can pull up
So,
a few.
the one first, like you should not invest in your 401k.
Yeah,
So
I've heard that one before.
when you hear that, first, what do you think they're trying to say you should do instead?
I don't know if I even looked at the video, but I've heard I've seen the clickbait title that said something like that or exactly that. If I had to guess, I don't know, maybe because you get more access to your capital outside of a retirement account, so there's less restrictions, and somehow that's relevant to these types of situations.
Okay. So I can see your investment restrictions, your investment choices are restricted.
Yeah.
You only have a certain finite number of investments to choose from. And
And it's locked up essentially unless you want to pay penalties until 59 and a half.
yes. Okay. Yeah, okay, those are fair.
Mm-hmm.
And I can see if you're trying to invest in something else that they're probably recommending. Like they have the don't invest in your 401k video and they pay for that coaching course. They also have the coaching course of how to buy real estate and another one's like how to buy a business.
Yeah.
So I can see like private investments, maybe not using ETFs and or general publicly traded stock market, broad diversified indexes. That might be a reason not to use your 401k.
Yeah. So a few situations have come up that have given me pause, right, on why a 401k is not ideal. I will say, even in those cases, we've gone with the 401k, but here are the reasons that have come up. Some 401k plans have just really poor investment choice options, meaning
Okay.
they're all either high fees, like actively managed options. There's poor selection criteria. There's also just a lot of fees that are passed on from the employer to the employee, in addition to the management fees of the individual choices. And that's friction. Yeah, certainly. I would say it's not ideal. Even so, we've still gone with it, and I'm happy to explain why in just a minute. But that's certainly been part of the calculus.
Okay, that's a good idea. So I have also seen scenarios where people who are building a business where the revenues of the business may be at a point where they don't have the capacity to fund their lifestyle and save for the future, but they are building up equity in that business.
Mm-hmm.
And so this is what makes it kind of so hard. It's like, yes, there have been times I have not put money in my 401k. Like my business was at a stage where I could not put money in my 401k. And there have also been times where I have funded it to the max, like above and beyond, set up a solo 401k and contributed more than what you can do as just a regular employee. And so I know that those one-off cases are there, but it's one of those things. I don't think. Yes, this could work sometimes for some people, but for the vast majority of people, the majority of the time, saving into your 401k, using that diversified equity index is the best way to increase your net worth over the next few decades.
Yeah. So here's why why we've geared towards the 401k in the past, even under non-ideal situations. Step one, we want to think about how much realistically can you target to put towards retirement, meaning this is money that's earmarked towards your long-term enjoyment post your employment, meaning it's meant for the decumulation phase of your life when you're pulling out money, which is potentially decades off, right? That's kind of the point. And the notion there is, if it's that long off, a lot of things can happen, meaning you may not be with that employer with an unideal plan for X amount of years, meaning you might have the opportunity to pull those funds out and move it to a traditional IRA or your new employer's plan, which may be more favorable. So it's not a life sentence, if you're in a plan that doesn't make sense in the current term. The second thing to think about is, I imagine why one of these TikTok videos is saying not to put it in the 401k. It's likely because what you alluded to, that they might be pitching some other idea that you can do from a 401k that supposedly has much better attractive prospects than the returns you might generate from a 401k. And that gives me serious pause, or that rings my skeptic alarm quite high.
There's a difference between. So I think this is that good distinction. Don't put money in your 401k because your 401k has high fees. Instead, you want to have a taxable brokerage account where you can use ETFs and get your expenses down below 0.1%. And maybe the compounding of that lower fees can make up for the tax deferral that you're giving up, maybe, because you're going to have long-term capital gains. Maybe. That's worth a discussion. But they're never providing that kind of advice. They're never saying, don't use the index funds in your 401k, use these active managed mutual funds in your 401k, use these cheap index funds out in a brokerage account. They're saying, don't put them in your 401k, do this other thing that's also very shady.
Well, so yeah, it's very unlikely it's a case of, hey, you don't want to lock up this much for retirement because it's outside of your budget. Let's put it in a safer, more accessible investment for the near term in case you need it. It's probably not that. Don't buy a short-term treasury or something like that. It's probably put it in something pretty risky that's levered pretty heavily. That's trying to target something pretty astronomical in terms of returns.
I think that's probably one of the key is that the vast majority of what you see on TikTok has a get rich quick kind of feel to it.
Yeah. I saw one last week and it said, why would you do anything else besides crypto? Here was the premise. Why did Elon Musk buy Twitter? He could have took that money and put it into crypto. And if he got 20% per year on his $50 billion, after 5 years, the 20% would have paid back all his money. And then it just was incredible. So
okay, I don't want to go into I don't know if I want to go into the crypto conversation right now, because that's why is 20% per year a reasonable expectation for crypto when no kind of equity risk premium ever has kind of provided that?
It's an important thing. Yeah.
So I guess we kind of have to that's a good example. Don't put money in your 401k, put it in crypto. That's another flavor of that, where at the very least it's understating the risks, but much more likely it can lose a lot of money It could work out, and it's going to work out for someone. That's the other thing. Like, there's always success stories. And we've talked in the past, like the Wyatt Earp effect, where if 100 people or 100 gunfighters are dueling, or let's say 64 because you go down by 2, eventually one comes out.
Yeah.
It doesn't necessarily mean that it's the greatest gunfighter ever, but if every gunfighter is a 50-50 chance, someone's still going to win. And I think that's a thing that we don't see ever talked about on kind of TikTok, but that's kind of like I love our conversations, is this advice. I don't even call it advice. What they talk about in the TikTok video has worked for someone, but it is unlikely to work for most people.
Yeah. So I think inevitably there's going to be some notion of you can end up with more money if you don't into the 401k. That's the pitch, most likely.
Yeah.
And in those cases, the premise is going to be the returns can be higher, right? That's how you get more money.
Yeah.
You get higher returns.
Yeah.
And that's where the concern comes into play, meaning, is it really possible to just get higher returns by switching up the instrument that you invest in? And, part of the answer to that is, yeah, you can, but you're going to be taking on more risk. And then the question has to come down to, well, is the amount of extra risk that you take on warranted for the extra returns that you get? So if it is, then yeah, something like that might make sense. But it's very unlikely that you're going to run into a situation where you can get more returns for less risk. And the reason why you kind of have to do that if you're jumping to an investment outside of your 401k is there's a lot of friction that you have to overcome to beat the 401k, because the 401k has tax advantages associated with it.
Yeah.
Meaning, if your 401k is averaging the standard market return after inflation of about 7%, then
again, I want to make this clear. Like, this again, after inflation. So we're talking like real returns. So if inflation is 3%, you might be getting a nominal return of 10%. That if inflation's 5, we could expect 7. Inflation's 1, we can expect 8. Like that's kind of the difference. But that's a good, and that's how investment theory has worked, is that risk-adjusted return, or that like that real return, is return in excess of inflation.
Yeah, when you're looking at returns over long periods of time, you want to back out the impacts of inflation, especially when you're comparing different investments. So, okay, so looking at the long-term return of the market over decades and decades, it's about 7% after inflation, or around 10% before.
Exactly. Okay. Yep.
And okay, so this 7% is your kind of bogey, what you want to try to beat. Now, if you're trying to beat that outside of a 401k, you have to account for the extra taxes that you would have to pay, given that you're not in a shelter anymore. What that effectively means is, we kind of did this math in like an earlier episode, but the lifetime compounding effect that you might expect from the 401k or some sort of tax sheltered account is like 25 to 30% extra that you might get if you were in that type of product versus not being in that type of product or that type of shelter. What that can mean is you got to make up for that in order to just break even outside of the 401k, meaning you need some strategy that can beat the return that you would get inside of the 401k, plus that friction to overcome just to get back to where you started. And the notion is, if your opportunity set is all the strategies on the planet, you have to figure out which of these strategies are going to give you that much of an advantage, kind of guaranteed to make it worth your while, or so much above such that even if it's not meeting those expectations, it still beats that hurdle consistently. Otherwise, you're going to end up falling behind. And that the whole premise is that's very hard to do.
So the other reason why I love the 401k actually has nothing to do with the numbers. It tends to be behavior related. That the 401k has this set and forget it. It's taken out before your paycheck hits your checking account. It doesn't once you set it up, doesn't require any extra action, and you get the benefit of that consistent compounding savings every year. Maybe you glance at it once per year at the beginning of the year, like, oh, 401k limit went up. I might be able to increase this. I got a raise. I can increase this. But that effect also tends to be much more powerful than taking money, not putting my 401k, it collects on my checking account. I build up a little bit of cash, and then I make some kind of singular purchase, whether it's crypto, real estate, business. Like, it's hard to calculate that like cash drag. Like, it takes me this long to save it up, so maybe I goes into cash for a year or two, and then I have enough to deploy, kind of thing. I don't want to say get into that aspect, but there's a very realistic feeling of like, okay, I've saved up enough cash. Oh, things just went down, or things look choppy. I'm not quite ready to get in. And that of just like accumulating cash tends to, just as life goes on, it goes on longer and longer. So I have talked to people like, oh, I meant to do that change. Let's see, was it last year, the year before? No, I guess it's been like 3 or 4 years. I've just been adding to my cash and forgetting to do something with it. And that kind of behavior does play out. And they weren't doing anything necessarily wrong, but it's again, a missed opportunity that, in addition to having to like reach those hurdle numbers, they have to have that discipline to do it every month. And that's another reason why the 401k works so well for so many people, that if you just max out your 401k, put in an all equity portfolio, and then you don't do anything else, and just you stay working, and especially if you have like a percentage of your income, like you're contributing 12%, and your income gets you get raises, that also increases your 401k contribution each year, and you get promotions, increase your 401k contribution. Like, if you forget to do anything, you're still putting yourself in a much better shape a few years down the road, regardless of that hurdle number. Even if it's just got that average number, like that effect alone tends to make the 401k makes the most sense for the most number of people. And to not put money in your 401k and try to do something else, while yes, it can work sometimes, to give that as like blanket default suggestions for everyone is a huge red flag, and one of the many reasons why I tend not to like any financial discussions on TikTok.
Yeah, so I'm also going to push back on the "it tends to work sometimes" notion. We
I think I
talked
said
about this in the past,
can.
right? Well, it can, yes. There's a greater than zero chance that it can work out. But let's highlight that a bit, because we have talked about this. The notion is, okay, now we need to find a strategy outside of the 401k that over a 30-year stretch outperforms the market to the point where you have 30% more money than you would otherwise, just to make a buck, right? To make $1 of positive profit. And we know this. Active managers try to do this as a profession day in and day out. And the chances of an active manager being successful at this endeavor of just pulling off what I just said, I'm going to say very generously less than 1%, probably 1 in 1,000.
So the closest thing I have seen that I want to give some credence to, but even then probably not, because I think I know why, is looking at things like private equity and venture capital, where there is a risk premium for the illiquidity, and there is a little bit of a premium for investing in something that's not available to the public. So it's both you have to go out and find that particular opportunity, and you can't sell it for years.
Mm-hmm.
The quick caveat is the people who do this professionally, they know that something like 50 to 90% of the investments they make are going to fail completely. Like it's just goes to zero kind of fail. Whereas, and they need one of those 10 to pay off enough to fund those other 10, those other 9. And I have seen enough where, okay, yes, I think this has a chance to outperform the market. But one, I think there's a huge survivorship bias concern that we only get data from the firms that found a success in their first 10 tries and they didn't run out of money. Because if you have like a 90% failure rate, the odds of missing on 10 out of 10 and you're out of money and your business closes is actually high enough that it doesn't get added to long-term data sets. So I think there's a little survivorship bias. And 2, for most people, like, can you stomach the idea of a 90% failure rate? And you have to try and find that one that pays off big enough. And some people think they do. They play the lottery. It can be fun, but this is not money you try and depend on to grow for long term. So that's why, I think it might be possible, but they to get access to, as soon as you try to hire someone to get access to these, the layers of fees start to get really, really big. You're talking like fees on the scale of 2 to 5%, and that kind of wipes out all of that premium you might have gotten from the illiquidity and like extreme small cap premium. But so I'll again, maybe some can work for some people, but for most people, just put money in 401k, 60% US, 40% international. Keep doing it every month for next decade or two, and you're going to be great.
Yeah, so I have a couple points to tag on to that. One is, for example, this might be close to a mantra, but I think it's worth being said. It just doesn't make sense to pay somebody to give you free money.
Yes. Oh, I like that.
Like, can you really pay somebody to give you free money? And how much would you pay for free money? And I got to explain what I'm trying to say here. I know you kind of get it, but
yeah.
Okay, so when you pay somebody to actively manage your portfolio, you're paying them to give you a return that's better than the market average. So if the market is going to give you $1,000, you want more than $1,000. So you're going to pay them money so that you get at least $1,001, right? So how much would you pay them to give you more money? Well, how much are they going to charge you to give you that extra free money, right? Are they going to give you $10 extra? Or, if they can make $2,000 and your bogey is $1,000, are they really going to give you, the extra $999? Or are they going to pocket every penny and give you an extra buck?
Yeah. It's again, the fees it's crazy. Like, I have seen fees when you look at like private real estate deals, the fees are like 15 to 17%. It's okay, but that's not the TikTok side, but it's just I say good idea. Like, yes, we have seen scenarios where the venture capital firm itself can make 100. They have enough money that's pooled up. They can make 100 deals, and they have a large law of large numbers benefit where they need 10 of these deals to pay for the 90 that fail, and they're actually going out and finding these deals. And some of the better ones I've seen, like, they can actually they have the management experience to actually help the businesses succeed further. So there's a not quite a synergy, but like they're adding more than just the dollars. They're adding their experience to the startups to help them make it more likely they achieve it. And so it's like, yes, if you go to get an MBA or you can start with these firms and you get that education, that experience, like, this is now your business. And I can say, okay, yes, that just might be a scenario. Like maybe you don't need to put money into your 401k. Either they're actually probably making some of these investments for the private equity deals inside their 401k anyways. But that's it's honestly, those people aren't going to TikTok to figure out how to make money.
Well, okay, I think still a bunch of those caveats apply, and
Yes.
the reason they kind of do is, again, you're paying somebody a pretty high fee to give you more
Yeah.
money than you would otherwise,
Yeah.
and if they have any chance of pulling that off, if they have this money making machine that can outsmart everybody else, how much are they going to charge for it?
Oh, they
Well,
charge
they're going to charge
ridiculous.
as much as they possibly can because they have a money making machine. Either that or they don't, right? And in which
Yeah.
case,
Yeah.
you know, it's either you win a buck or you lose all your fees and then some.
Yeah.
So, you know,
Yeah.
that's thing one. Thing two is, okay, so there's a very small chance, just statistically, that they can pull this off if you're paying somebody, right? Because
there's a difference between like you actually doing the work and hiring someone to do that work for you.
yeah, right. So over an investment lifetime, if that's what you're going for, strategies where you're outsourcing the decision making and the authority to outsmart the market, then whoever is doing it is going to need to do pretty well after fees, right? And we've looked at this data from many different angles. It's very tough to do.
Yeah.
Maybe it happens in rare instances, but you know that might be from here to here. But
Yeah, I
we're
mean,
talking
you'll
about
see
30
like
years, right?
yeah, you'll see small period overperformance that is hard to feel like it's replicable over the next decade.
Right. Yeah.
It works. They had overperformance last decade, and then you'll see a lot of scenarios if you have good kind of meta analyses of like once they got to here, their next decade they were just average.
Right. Yeah. Yeah. And so let's say they end up pulling it off for 10 years. What are the chances that they can pull it off for the next 10 years when you join them, you know, after you've seen they've done it? And research again suggests that there may be very little correlation between what you've already done and what you're able to do, right?
Yeah.
It's the main reason why the SEC hammers into these types of agreements. Past performance is not indicative of future results. So it's one of the core things that they want us to say over and over again, right? But it's the core thing that goes out the window at the first opportunity. So okay,
past performance and actual future results. But I got this thing for you.
But here's my past performance.
Yeah.
And that's all you have to go by, right? So okay, so here's the hitch, right? If you are going down this path, you're signing up for a couple of things. First, you're signing up for the notion that every single moment between now until you're ready to pull out this money and maybe transition to a more passive strategy, right? As long as you're active, every single moment between now and then, you have to decide, is this the best place for my money? And that can change tomorrow, the next day, the next week, it can happen at any time. And when that change happens, it may be even too late, right? You've already lost half of your money. Now, what are you going to do? You have to find something else, or you can sit on that cash that you get back, whatever is remaining, and you have to find the next venture. So it's this vicious cycle of opportunity that you constantly have to chase. And you know, the biggest hitch is, you know, here's the opportunity set we're looking at. In option A, you have this passive strategy where you're 7% over, you know, the 3 decades on average, if history is our guide. Which again, there's caveats there, but this is just saying the overall opportunity of the markets is what you're going to get. And option B is you may have less than a 1% chance of doing fabulous, and probably a 99.9x% chance of underperforming. And the hitch is you won't know which of those two buckets you're in, you know, the 1% or the 99%, until it's too late.
Yeah. Okay. So again, most people saving your 401k. It's just it works so well, so consistently. The theories behind it, the practice behind it. Save more. It's good default automatic savings. Trying to think of, like, other TikTok themes. One of the big ones. So again, I was reading an article, and we'll put in links about, like, the red flags to look for. Most of the people who are talking on TikTok are not registered or licensed in some form, in any form.
Yeah.
So we've had discussions in the past. It's like kind of esoteric about there's between a fiduciary standard and a suitability standard. There's IARs, investment advisor representatives of an RIA, a registered investment advisor. They are registered with the SEC or their particular state. They can give financial advice for a fee. So they can charge a fee, give financial advice, and they are registered to give that advice. There's also registered representatives, RRs, of broker-dealers. They are registered under FINRA, which is something like Financial Regulatory Organization. It used to be a combination of the NASD and the New York Stock Exchange. And they are registered to sell financial products. Usually things like mutual funds is probably the most common one. Variable insurance products such as variable annuities, variable life insurance. They can collect a commission on selling stocks in the past. That's a little kind of outdated. But they have a suitability standard. Like, is this thing appropriate for this person? Like, they have a know your customer rule. They can afford this thing. So they also may give financial advice. There is language that if the financial advice is incidental to the sale of a financial product, then that is okay. That's like, okay, here's how much you need to put in a mutual fund to save up for retirement. They may or may not be charging fees for their advice because they usually get paid by the commission on the investment. It's usually inside the investment, and the broker pays it out to the individual. Either one of these can be appropriate or acceptable depending on the person's situation. And I point these out because in both of these situations, there are examination requirements and regulatory requirements to continue education. Like, they have to show that they actually know what they're talking about. We also are both certified financial planners. This is an extra designation that had more stringent examination requirements. It's a much more intensive test showing that we know about providing financial advice and financial planning for individual situations and sometimes small businesses, because the owners tend to be linked to their small business pretty tightly. We also have continuing education requirements to maintain our CFP designation. What you see on TikTok tends to have none of this. They are not registered with the SEC. They're not registered with the state. They're not an RIA. They have no continuing education. They are not registered representatives. There's no like advice suitability. Like, there's no suitability standard. There's no initial examination. They might call themselves like financial coaches, and here's a financial program or something like that. They'll also tend to add things like do your own research as a caveat of they're not providing financial advice to any individual. They're providing generic advice for everyone. It's like, this may not apply to you. So that's some language. But the fact that they're not registered at all, they have no examination requirements, there's nothing to prevent them from providing really, really bad advice. There's nothing to stop that. And so just going in to distinguish good advice from bad advice, if you know nothing, like, we would hope the regulatory bodies and the CFP designation and like the other things we've gone through would give us some standing that you're at least willing to listen to it and give us a time to explain why this may or may not make sense for you, which is also why Trish and I tend to talk for an hour at a time. This also doesn't happen in a TikTok video. It's not There's no nuance. Like everyone should do this. This is the best thing. If you put money in your 401k, you're an idiot. Like that's kind of like how bombastic they have to be if they're going to try and do this. And so I was trying to like, can you think like how can you expand on that of like the fact that we have regulatory standards and they have nothing? It's like when you hear that, is that a red flag for you? Like, is it outrageous to you as it is to me?
It's tough because here we are going through all of these check boxes of what it takes to do this professionally, right, as a career. And anybody, I guess, can have a soapbox, right? Anybody can say what they feel as long as they have the appropriate disclaimers, I guess, right? Please consult your financial advisor. This isn't medical advice, legal advice, tax advice, financial advice. And you're kind of.
I don't think they're getting those. Like, I think their disclaimer is do your own research, because as soon as they add like professional sounding disclaimers, that actually gives me like a little more credence. Like, okay, they've actually like they know what is legal and what's not, and they know what they're doing is not legally binding.
Maybe, yeah. Well, so the other thing is, this all depends on which border you're operating inside of. Like you could get advice from any country on the planet.
Oh, that's a good idea.
It doesn't mean, it's kosher.
That's a good point.
US.
So 401k is named 401k because that's the actual like tax code that governs the employer-sponsored retirement plan. So that's why we also have 403bs, because 401ks are plans for for-profit companies, 403bs are for nonprofits, usually schools, hospitals, things like that. But this is like U.S. IRS tax code. I know other countries have other retirement plans, but it's totally possible that it's someone from Russia saying, don't put money in your 401k.
Sure. Why not?
You should invest in Russia. Yeah. Oh man, I hadn't even thought about that part. Yeah. Okay. Go on.
It's interesting because when I first started this whole endeavor, I had moved away from the hedge fund career, and I started talking to friends and family, and I just started noticing there's a lot of misinformation out there. There's a lot of financial decisions that my peers and friends and family are making that I just don't agree with. So what really started going off in my mind is, okay, well, maybe I can push back against all that. And that's where I started with the blog. That was, how this whole venture began. And I started just saying, at least if I put out my best thing, the planet can't say they haven't been told once, right?
Yeah.
By me, at least. So that, and then it evolved into the podcast and whatnot. And eventually, when it got to the point where I wanted to give advice, I'm actually coming at this from a different angle than Aaron, than you did. I wasn't an advisor in my past life to, families and individuals. I was advising pension funds, endowments, foundations, more on the institutional side. So I literally thought if I wanted to provide advice to individuals, I would set up a lemonade stand and people could walk up to me. I could tell them what I thought. But, when I actually started going through the motions of what it takes and realizing the different choices that I could make, I landed on a set of choices that I thought made the most sense from my perspective. And Aaron, it looks like, here we are, right? It looks like you made many of these same choices. And, as far as that decision framework went, I landed on the registered investment advisor approach. And Aaron, you did the same, right? What that also means is we're held to this fiduciary standard, right? Not all forms of advice need to live up to this standard. If we were selling other types of products that involve commissions or working with a broker dealer, we would not need to live up to this standard to conduct our business, although we could offer advice that's incidental to operating in that capacity. Even so, we went down the RIA approach.
Yeah.
What that means is, a fiduciary, we need to put the best interests of our clients ahead of our own, which is not a standard that you need to meet if you're in a broker dealer or if you're selling insurance products, or certainly if you're having TikTok videos and you have a disclaimer that it's not advice. But beyond that, Aaron, you and I, we have our certified financial planner accreditation, which is above and beyond what the state requires. It's one of the higher level. They self call it the gold standard for advice, right? For getting
I think
advice.
it's still the best for anyone providing financial planning to a household. I think that there are certain like niche specific things that can apply to some segment of the population, but a CFP can likely help anyone with financial planning, any kind of individual household.
That's what it's geared towards. Like another designation that was common in my previous hedge fund life was a CFA, a chartered financial. And there you have a deep dive in understanding how the finance industry works and the nuances, behind that.
Yeah, I always thought it was like kind of very investment specific.
Yeah, and not necessarily retail investment, but more commercial and So, but we got the CFP designation for that reason, and then we went one step further beyond that, and we decided to be fee only. So that this is one more step in a direction of aligning interests with those receiving the advice. And the notion here is we're saying up front that we're going to run our businesses with zero commissions. And the idea there is any compensation that we receive is directly from the client, and we will have no sort of kickbacks or no sort of third-party arrangements or no sort of commissions for the products that we recommend. So, having that in there.
I think maybe in a future episode, we'll go through story time of my life as a duly registered IAR and registered rep, and filling in some of those blanks with specific examples.
Sure. Yeah. And there's just one more step that both you and I did is we also decided to form independent businesses that weren't under the umbrella of a larger organization. And again, that just means that we get to make the final say on what we think makes the most sense for our clients. We don't have any mandates for revenues or products or business line or anything like that. And again, the goal is to provide the best advice possible. So all of these checkboxes that we each independently landed on, I think have their own merit on why it makes sense to put in place if you're going to be providing advice to somebody. And then, for the client's perspective on the receiving end, I think those are things to potentially look out for, we're giving some guidance here on what makes sense given the sea of advice out there.
Yeah. I always tell people that they're kind of talking to me and other advisors, they're trying to decide who to hire. The two big things are, one, make sure they have a CFP. That's just, and it does make a difference that they know what they're doing and they're making that commitment to the continuing education. And two, you have to like them, because good financial advice is so personal. It's almost intimate in a way where you will be sharing, the clients are sharing information about their life with their advisor that they have told no one else except maybe the spouse. And that to me is the other kind of crux of this, is like, yes, we have a podcast. We try to give these advice, but we also like give all the caveats of how this might not apply. But anytime I'm working with a client individually, it is tailoring recommendations to them specific. And I think that tone is something completely missing on the TikTok side. They are saying, this is for everyone, you must do this. And they never give caveats. They never give like, here's for the people it doesn't work for, or here's like the narrow segment of the population that this should work for. Again, I use that word bombastic, but it really is trying to be, I think we talked in the Fox and the Hedgehog in the past, like this is the big thing that everyone must do. And if you're not doing this, you're an idiot. And you and I try to try as much as possible to make our recommendations personal, but we know like there's nothing we can do on this podcast, on this video, that can be personal. It does require the deep understanding of our clients' lives to actually give good advice.
Right. Yeah, you touched on. So I pulled up this article. I think Aaron, you had sent it to me, but it just highlights some of the things to look out for. I wanted to make sure we didn't leave anything on the table, and you just covered one of the key points. So I'll go ahead and share the screen so that we can see some of the others. Okay, so
Is this the Yahoo article?
yeah, it is.
Okay. The 5 red flags to look out for when taking advice from financial influencers.
Right. Yeah.
Man,
So
that phrase just gives me like heebie-jeebies. I hate like financial influencer.
oh boy.
Like, sorry, go on.
Well, we probably influence a handful of people. Does that count? Like on our YouTube?
You're right, but I would not call myself an influencer because we also like our income. It doesn't come from this podcast. Our income comes from our clients. So yes, I influence my clients. I don't influence via social media.
Right. Yeah. Okay. So the 5 things. The first thing to kind of look out for, shady credentials. We did kind of cover that a little bit, but it does also highlight one thing as well. If you're looking out for credentials, you can also check on the SEC website, brokercheck. Is it .org?
I think it's broker. Yeah.
Brokercheck.finra.org.
Google search BrokerCheck. BrokerCheck is by FINRA, but it also links to the SEC's IAPD, which I want to say is the Investment Advisor Public Disclosure.
Right.
So
yeah.
Yeah.
So you can look up anybody's name or firm, and you can get background on them. Sorry, Pam. It's more about me, not you. And you can click into them, and you can actually see a bunch of things.
Yeah, to go to the SEC site. So again, because you're not a registered representative, your data isn't on BrokerCheck, but they will send you to the Investment Advisor Public Disclosure, which is run by the SEC for all RIAs and IARs.
Right. So, thing number one, you want to see, do they even have a profile? If they're giving you some sort of advice, are they on here? Right. And then from here, you can see their entire history as they were on here, and the licenses, their exams, where they're licensed and able to do business. And you can get their firm disclosures. That's someplace on here.
So disclosures that's a specific thing. That is some kind of complaint or issue that they have had in the past that regulators have found that they have to disclose. We did something that violated regulations at some level, and we need to disclose that. So it's not a saying that you should never work with that advisor, but there would be like if fraud was ever an issue in the past with any advisor, that would be in their disclosures. So you need to kind of find if they had a bankruptcy. That's another disclosure. So those are things. Just look at the disclosures to see if they have done anything illegal enough to kind of violate financial regulations.
Right. And part of that is each firm has to put out a brochure that breaks down in details all about their business, including their products, their fees, the regulatory issues, their kind of a little bit of like a CV and background on the principles of the firm. And you can download that for all of these different businesses that are operating, especially if you go to a business and you're not quite sure what is this business even about? The fees don't make sense from the website. Well, you can get it in black and white spelled out for any RIA by going to the public disclosure brochure by searching for that firm. And like you said, Aaron, you can also figure out if there's any red flags that you might want to consider in making your decision.
Feel free to look up my name real quick. Because I know my history is a little different, but there's good things to point out. Look on BrokerCheck first, I think.
Okay.
I might just take you to the same spot because I no longer have a Series 7. I still have my Series 24 doesn't have to be sponsored.
I just learned your middle name, Michael.
Oh, yes. So this is actually a good example. If you kind of scroll down, it shows you the history And this is actually a good example. So when I graduated in 2005, I started with Ameriprise 2006. So I had a Series 66, which is a combination of like 65, 63 at the same time, Series 7, and my Series 24 for actually supervision. But if you kind of scroll up, you can actually, but here's two different views. One is just the list, but this is kind of a timeline of different firms that I've worked for over the years. And so, and I'll probably do tell a story next time. Like, I was a registered rep under LPL from 2014 to 2019. And if we go to the IAPD site, we can see that I was also an IAR. Do individual again.
Okay, right here.
Yeah. So if you scroll down.
Yep.
So okay, this actually shows it. So this has information for both. Scroll back up.
Yep.
So I was an IAR under Vantage Wealth Management at the same time that I was a registered representative for LPL, and before that was Cambridge. And so when I left Vantage/LPL and started my own firm, that was when I made a commitment to be fee only. So I'm no longer a registered representative. So I can tell some stories like how the fact that I'm on both sides of this chart kind of works. But that's a longer conversation for a different day. But the fact that, like, yes, you can look up me and you can look up Trishul, and anyone who gives you the name on TikTok, you look up their name to try and figure out, have they gone through anything?
Right.
Okay.
So
what was the other?
Confirm credentials, big thing to do. And again, you can do that yourself. Second thing, we did touch on this, be wary of just general advice, right? But it's easy to misinterpret. It can miss a lot of the nuances. It may only apply to certain situations, and it may sound too good to be true. It even says here, influencers tend to focus on only one or two things that work for them, whether it's passive income, right, or some sort of chasing the stock market with some new idea, or obviously the Bitcoin stuff, right?
Yeah.
So just be wary if it's too generic and it just talks about some really specialized situations. There might be a lot of nuance that's missing from that few minute reel.
Yeah, it's like when you said the I also like, maybe next time you can share your potential initial coin offering idea. Like, when you go to crypto, anyone can create a cryptocurrency. Anyone can create a coin. There's no particular reason why any coin is more valuable than any other coin. But like, there's a fiat currency idea, but like, anyone can create a cryptocurrency. I'll just leave that part there. And so that is part of my red flags when it comes to that. Like, you should don't invest in Bitcoin, invest in this cryptocurrency, which I may be happy to create, but I don't have to tell you that.
Yeah. Very likely the reason that's being pitched is because the past performance over X period looked awesome, right? So
yeah.
Okay.
Oh, when it goes from 1 cent to 2 cent and you get 100% return, that looks amazing.
Yes, it does. Okay, so no disclosures up front. We mentioned that.
Yeah.
We want to look for transparencies, the disclosures that we mentioned, that they should kind of be all over the place. Selling over advertising.
This is the kind of what we talked about. Like, don't put me in your 401k. We're going to put in this other thing that you should watch my other video, and you're going to hire me to be your coach to teach you how to do all those things. I think that's one of the things that you and I have talked about. The work that we do with clients, we're actually very upfront. Our clients can do all of this on their own. They hire us in part because they want us to teach them, but also they just have busy lives and they need someone to help to make sure it actually gets done. Going back to like the 401k idea, like putting money in the 401k over multiple months, over multiple years and decades, like that's the benefit. The 401k itself does provide a marginal benefit, but the hard part is making sure you actually get all that part done. And so I will tell clients like some of this, a lot of this you can do yourself. I'm not going to do anything that is like earth-shattering. There's no like hidden knowledge that I have. Like I do happen to know more, but I'm going to share it with you, and you can go verify yourself. And it's kind of like I sometimes liken it to like hiring a personal trainer. Like most people know if they want to lose weight, you exercise more and you eat less. But that's hard. And so if you hire someone to keep you motivated, to keep you on track, to keep you on schedule, that makes a difference. And so sometimes it's I can help you be like a filtering function. I know that there's dozens of different ways we can invest our money, but in talking to you, I can quickly narrow it down to these 2 or 3 to help your decision-making process. It saves you time doing your own research, kind of thing. But again, we don't provide any like magic formulas. Nothing that we do with our clients is something that they cannot do themselves.
Right.
And I think that's one of the things that comes off of TikTok. It's like, buy my course and then you'll be rich. And like you said, like there's no one's selling free money.
Right.
It's if they aren't willing to share that with you, then it sounds a lot like their incentive is to get you to buy the course more than to actually make you rich.
Yeah, and that's where the money is for them.
Yeah.
Right. So, watch out for sales, right? Are you being educated or are you being sold?
Okay, so I like that. Selling misinformation for profit or influence messes with people's lives and finances. There's a lot of selling misinformation for profit.
Right.
So.
Okay, and last point, I think, that is the 5th one: lack of education and experience. Right. Here we go. You even see the CFP and Aaron, have you seen a chartered financial?
I actually had that at one point.
In the wild?
The chartered financial consultant and the CFP have the same education requirements. You have to go through a series of textbooks. I think it's like 8 textbooks I have lying around somewhere. And you take a course, kind of an online course showing that you understand the material in each textbook. The CFP has the extra singular examination for all of it at the end, and has additional continuing education requirements. So at some point, I chose not to pay to renew my CHFC because the CFP included all the same knowledge and all the same information.
Right.
So yes, I did have that at one point, but I chose to let it drop.
So they're pretty similar. CFP goes a bit farther, maybe. Is that kind of okay?
Yeah.
Okay, but yeah, you want to check, as we just said, what's the experience, the background, the education, the licensing and accreditation of the.
You can also go to the CFP website. It's cfp.net, and you can actually verify that Trish and I have our CFP designations.
Right. Yep, that's also true. So you can't just put the CFP anywhere; they will go after you. So
yes.
And they also take ethics very seriously, above and beyond what the regulations require. So that's also a big part of it. They have their own governing body that enforces these standards that they require us to comply with.
Yeah. So again, if I had to give my TikTok intro version as our conclusion, if someone says, don't invest your 401k, it says passive investments, real estate, crypto, like those are my red flags immediately. Like I'm not going to outright dismiss them, but I'm definitely coming in more skeptical. Like those tend to be themes that I see of, okay, if I'm listening to this, it's with a very critical ear. It's like, okay, I'm looking for logical fallacies kind of thing, where those tend to be the big red flags. And sometimes I'll just move off, but sometimes okay, I want to understand what is out there and what my clients might be seeing, so at least I understand.
Yeah. I think in addition to that, what we've said about you can't pay for outperformance. There's no secret strategy that can do better than everybody else that if
Yeah.
only you paid some money for, you would have access to.
Yeah, I agree. Yeah. I think your other phrase was better. What is it? You can't pay for free money or something like that. You can't pay
Yeah,
someone to give you free money.
right. Yeah.
That's
I don't know
a
if it
better
titrates
TikTok.
as well, but sure.
That fits
Should-
our TikTok intro.
I was going to say, should that be our title for this one?
You can't pay. You can't. Oh, that's right. You can't pay someone for free money. I like that. Yeah.
Right. All right, we got a title. It's a wrap.
Okay. Sounds good.
Well, good stuff, Aaron.
Thanks for the conversation. Glad we didn't go under an hour. We gotta stick to our. I mean, it's not like stick to our guns. It's like just the way we are. Yeah, we're living our life the way we are. We're true to ourselves. There we go. That's what I was thinking. We're true to ourselves.
There you go. It is what it is.
Okay.
Yep.
I'll see you later, Trishul.
All right. See you, Aaron. Good stuff. Thanks, everybody, for listening and watching. If you're enjoying these conversations, do spread the word, like, and share. Thanks, everybody.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.